The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Welcome to Squawk Box Europe. I'm Karen Cho with Ben Boulos. These are your headlines. US inflation slows to 3.4% in July, while the core print drops to 2.5%, making life just a little bit easier for the Fed, with markets now leaning towards a hold at its September meeting.
The CEO of the world's largest sovereign wealth fund says there are reasons to be wary around AI financing, even as the fund's gains are mostly concentrated in tech. Nicolai Tangen still painting a positive outlook, though.
It reminds us of things that we have seen in the past, and it is for sure one of the worries. On the other hand, economies are very, very resilient, and supply chains are flexible. I do think that AI over time will be deflationary.
Shipping giant Maersk hikes its full-year guidance, citing a robust volume growth outlook, while its peer Hapag-Lloyd sees revenues rise in Q2, driven by higher spot rates. We'll be hearing from the CEOs of both companies right here on Squawk Box Europe.
We kick off the day with some data, and defying expectations has been the UK growth story. We're expecting to see a flatlining, some market participants calling for a decline in growth in the latest monthly figure for June, but we're not getting that. In fact, we've got expansion still 0.3% on month. So that is versus the expectations for a flat result. The parts of the puzzle here, and I'll just give you the print too now for the output levels, 1.1% on year versus 0.8% expected. But if we just drill down into the various different components for the month, we were expecting to see a drag on construction. This is lower, but is not as big a drag as it could have been. Minus 0.1% on month. Expectations were for a drop of 0.3%, so not quite the same level of decline. Industrial output, minus 0.2%. Again, this one has been a bit of a variable and is actually more disappointing than expectations. The market was calling for an improvement here on that industrial output level versus the drop of 0.2%. Manufacturing output, 0.5%, slightly under the 1.2 anticipated over the course of the year. The manufacturing output print over the month. So if we just look at the monthly levels here, that is minus 0.5% on month, again, worse than expected. So there are quite a lot of moving pieces this morning. I want to push on to what we had on the services print. For the month, 0.4%. So closely watching the services, given just what the impact on consumer wallets has been from the Middle East situation. So that is up. What it means for the year, it's also above expectations. 1.6% for the year versus a poll of 1.4%. So one of the contributing factors to some of the growth figures that we are now witnessing today. Business investment over the course of the quarter, up 1.7%. So also decent. The reaction function that you're seeing on markets this morning, we've got sterling dollar that is higher. We're 134.9 in trade. That is holding on the back of the data that is crossed. So fascinating to see the expectations here actually improved upon by the data as it crosses. Now, speaking of data, let's get into the inflation numbers stateside. Big pivotal moment for markets. US inflation edged lower last month. The latest CPI reading for July came in at 3.4% on the year, down just 1 basis point from June's reading, as did the core metric, which fell to 2.5%. While marginally improving, the decline still puts inflation nearly 1.5% above the Fed's target. Following the data release, traders did pull back from near-term expectations for a rate increase by year-end. The CME's Fed Watch tool now puts the chances of a hold at the central bank's next meeting around 10 percentage points higher than it did before the print. But concerns continue on the fiscal side. Wednesday's 10-year Treasury auction fetching the highest yield since the global financial crisis as the country's budget deficit surged to a July record. The total borrowing figure for the year now sits at $1.8 trillion, more than last year's entire fiscal deficit, with 2 months still left in the fiscal year. And Ben, we've heard this over and over again for a lot of fund managers. Be wary of the long end of the curve because of these fiscal challenges.
Yes, and that inflation print coming in line with expectations gave some relief to equities. You can see two of the three main benchmarks closing the session in positive territory. The Nasdaq leading the way higher, up around 0.5%. The S&P 500 advancing 0.25% on the day, and the tech-heavy Nasdaq helped, the S&P 500 helped by the strong performance of CoreWeave and Supermicro computers. The day before, they had posted some pretty robust figures after the bell, and share prices for both those companies rose, really setting the tone for the tech sector. The Dow, though, on the other hand, saw a third straight day of losses. The rise in the oil price over the past few days weighing on sentiment on some of the more energy-intensive companies and industries listed on the Dow Jones. Let's have a look at how things are playing out in the Asian trading session, and plenty of green to be found. Again, the Kospi advancing for a second day, up 2.9%, just shy of that. The Nikkei also decisively in positive territory. It's worth remembering the Kospi has some of the big tech names listed, Samsung, SK Hynix. They benefit from that positive sentiment that we saw on Wall Street, as I say, after those updates. And the relief from the fact that inflation had cooled slightly year on year from the US. It's worth mentioning, just Hang Seng there below the flat line. In terms of the day that's anticipated, when Thursday trading begins in Europe, we are just under an hour away from that, and a positive start there being called. The relief around the inflation print, which indicates that the bets on the Fed hiking rates have pulled back after that. Some relief there in terms of what is expected. Let's cast an eye ahead to what's being anticipated on Wall Street. And again, a positive start to the trading day pointed to by the futures there, although slightly more muted gains being called, perhaps because, yes, we had that CPI inflation print in line with expectations, but later on Thursday we get the producer price inflation, the factory gate gauge, which tells us, I suppose it's slightly more forward-looking in the sense that it gives us an idea of the price inflation faced by producers, which of course gives a hint about the consumer price inflation that may well be coming down the track. So investors moving a little cautiously in anticipation of that figure and that data. Karen.
Ben, two stocks hit by AI trade volatility overnight, Cerberus and Cisco dropping after the bell after failing to meet sky-high expectations in some areas. Cerberus shares slumped around 16% in extended trade on the back of a miss on sales, and its revenue forecast for the current quarter falling short of some estimates, according to Bloomberg. Meanwhile, even the top and bottom line wasn't enough to stop Cisco shares also from facing some pressure. But a very strong run, though, that San Francisco stock over the course of this year. We're going to hear from the CEOs of both companies when they speak to our US colleagues later today. And you're looking at Silicon Data's H100 rental price index. If we can bring that up for you, it does track the hourly rental price of NVIDIA's H100 chip. This is the first time we looked at this. Now the company has partnered with CME Group to launch what could become the world's first futures market for compute power, allowing investors to trade the price of AI computing capacity in the same way they currently do with assets like oil and electricity. The company pitches the idea as a more reliable method of price discovery for computing power. The CEO, Carmen Lee, pointing out in a statement that two companies buying the exact same GPU capacity could pay wildly different prices. It also means investors will be able to get exposure to the AI infrastructure sector without having to invest directly in data centers or hyperscalers themselves. So I've covered a lot of moving asset classes, got to say, around the set. This is obviously a first talking about this type of price action. No doubt we'll be talking about it now on a daily basis. Well, all this comes after NVIDIA partnered with some of the biggest names in finance to rebrand its computing capacity as a, quote, investable asset class. But it also led to more concern over circular financing. BlackRock boss Larry Fink earlier this week compared data center financing to the mortgage-backed securities markets of the 1970s, calling it the next future for financial engineering. Now questions are rising over what happens next. In a note seen by CNBC, Wells Fargo traders asked whether the move means AI factory loans will eventually become repackaged into a collateralized loan market. All this when no one actually knows how the value of NVIDIA chips will hold up over time, let alone the demand.
Well, on that note, I asked the CEO of the world's largest sovereign wealth fund, Nicolai Tangen, about the risks of circular financing.
It is for sure an additional cause for concern, because a lot of this financing, it does look circular. It reminds us of things that we have seen in the past, and it is for sure one of the worries. I mean, generally speaking, of course, AI valuations is one of the things we look at. We look at debt levels generally among states. We look at trade barriers, geopolitical tensions, and so on. So for sure, there are reasons to be concerned. But on the other hand, economies are very, very resilient, and supply chains are flexible. I do think that AI over time will be deflationary. And then, of course, we have the whole humanoid robotics revolution still to come.
Well, that was part of a fairly wide-ranging conversation that I had with him, which I kicked off by asking about their record first half.
It was a blowout first half of the year, and you are right, the gains were really concentrated in technology in particular. When we look at the top 10 contributors to the gains, actually 9 out of the 10 were in chips, and number 10 was in AI also. So yes, these are concentrated, very concentrated gains indeed.
And then some may look at this and say, now would be a great time to do some profit taking and rebalance the portfolio and the fund. Do you have any plans to do that?
Well, it's not really the way we run things here. We are an index near fund, and so we typically will be invested in everything around the world. We own 1.5% of all the companies in the world. In Europe, we own roughly 3% of all the companies, and so we typically are invested in everything, which is very good, of course, when you have periods like the first half of this year.
In which case, to Norwegians who might be watching this thinking, is Mr. Tangen saying that if there is a downturn in the markets, our sovereign wealth fund will lose value, and he is comfortable with that?
Well, for sure, if there is a downturn in the markets, we will lose money. We participate in the upturns and the downturns, and that's the way it's been for the last 30 years, and it's been for sure a very, very good ride. Now, I don't think we'll have a repeat of the last 30 years going forward, so I think there'll be tougher times ahead. But I do think for a long-term large investor, you just need to be well spread out and invest for the very, very long term.
Just more generally, Nicolai, you're so well placed as the CEO of a fund that has done so phenomenally well to give us a health check on the global economy. What is your outlook for the rest of the year, the next half that we are just entering now?
Well, I'm not sure about the next 6 months, but a general observation is that economies and economic growth has been very resilient given what's going on. If you go back 2 years and you told me, okay, this is going to happen with the Hormuz Strait, trade barriers, geopolitical tensions, and so on, I would never have thought that the market would be as resilient as it is. And so supply chains generally have been very, very flexible, adaptable, and agile. Companies are very good at managing under uncertainty and under changing operating conditions. And markets have been resilient. So it's difficult to say exactly how this is going to end up, but for sure we should not be expecting the same kind of returns going forward as we've seen over the last 6 months.
Well, it was a wide-ranging conversation. We also touched on the investment in SpaceX. There had been historic tension between Nicolai Tangen and Elon Musk when the Sovereign Wealth Fund voted against a pay package deal for Mr. Musk at Tesla. But it seems that the two have patched things up. And they are very much involved again. And the investment in SpaceX, he said to me, is about what they do. He said we have typically take 100 IPOs on each year because he said that it was fast tracked onto the index, and so they are a near index fund, and so they do track it. Even though, obviously, after the IPO, we saw the SpaceX price drop. Right. The other point that I put to him was that a lot of the sovereign wealth fund is born off the back of the oil and gas revenues that Norway gets, and they then reinvest it. And I said, what Europe's going through at the moment, there are places in Europe where people may feel that actually other places in Europe with the wildfires and the droughts are paying the price for Norway's wealth. And he sort of very robustly sort of pushed back, acknowledged the problems with the weather, but said it's not down to that.
I want to pick up on the warnings because I think the warnings are significant around AI and what the blowback could be far away from Silicon Valley if there is a problem. But what we also heard overnight were very strong messages from the likes of Cerberus and from Cisco. Both are talking about AI demand and just how strong it is. I mean, the line from Cerberus was that AI demand is through the roof. We saw from Cisco $4 billion in Q4 orders because of the hyperscalers. So very different responses here, and I think that's the problem. What's been baked into a stock price if there are concerns around whether the growth is going to be sustainable? And when it came to Cerberus, the tailing off in sequential growth, that was a problem. The market didn't see much more growth coming through in the quarter versus Cisco, where you did have the growth and the outlook was very strong. And you've had very different share price reactions. Don't forget, Cerberus has been down 16% this year after a slump of 16%. Versus Cisco, that's been up about 60% towards a record high. The stock is only off 4%. So I think what we've got going on here is a market trying to pick its winners, and obviously slightly different for Nicolai Tangen when he's trying to track the market. He's sort of wrapped up in all of these different exposures in many ways.
Yeah, and we touched on that, and he made it very clear that when you're on near index fund, you have to be prepared to ride the lows as well as the highs as well. Coming up on the show, we'll speak exclusively to Pandora CEO Berta de Pablo-Barbier as the jeweller reports earnings amid volatility in silver prices. Europe's fifth heat wave is due to peak today. We'll explore the future of climate resilience with venture capital fund Planet A, and we'll talk shipping with the CEO of Hapag-Lloyd, Rolf Haben Jansen, as well as from Vincent Clerc of Maersk, both reporting their earnings today.
I'm Steve Sedgwick from CNBC, and in my new podcast, Executive Decisions, I ask powerful leaders about their decisions that changed everything.
I'm not frightened of making tough decisions, and I think leadership can be very lonely.
Business leaders should not stay quiet in a world which is super complex.
It is absolutely fine to also change your mind.
Tough calls, personal crossroads. These are the stories that we can all learn from. It's Executive Decisions from CNBC. Get it wherever you get your podcasts.
Welcome back. Traffic through the Strait of Hormuz is near a 3-month low as doubt grows that the US and Iran will reach an agreement to open the waterway, with negotiations appearing largely stalled. US President Donald Trump on Wednesday reiterated his claim that the US has total control of the strait. Dan joins us now. What does it look like to you, Dan? Does the US have total control of the strait?
Well, Ben, good morning. The focus this hour is still this escalating war of words between President Trump and Iran over the future of the Strait of Hormuz. In a Truth Social post overnight, President Trump saying the United States has total control of the waterway and also suggested here that Washington may keep it. He described the US naval blockade as a wall of steel and also said there was nothing Iran could do about it, and also claimed that Tehran's military and economy have been severely weakened. Well, no surprises to see Iran pushing back on that. Its Persian Gulf Strait Authority, which the US does not take seriously, by the way, claims that, of course, the United States is not in control, and also adds that it doesn't necessarily change the situation on the water. It says Hormuz remains blocked until Iran's conditions are met. There's also a really big disconnect in the shipping numbers as well. The US Energy Secretary Chris Wright was out this week saying almost 9 million barrels a day of oil are now moving through Hormuz on a 7-day average, and also said that total regional oil flows are running at around 15 million barrels a day. Well, by contrast, Kepler data shows overall vessel transits through Hormuz averaging just around 13 ships a day, about 90% below pre-war levels. Those numbers aren't directly comparable. Wright's talking about oil volumes, Kepler talking about ship transits, but together it really shows why there is still so much uncertainty
over just how open the strait really is. It's back over to you.
Dan, thank you so much for that. We're going to kick off a conversation with many of the big shippers this morning as they've produced numbers. Hapag-Lloyd has reported a $173 million net loss for the first half of the year. As the shipping firm said, challenging market conditions and operational disruptions weighed on revenue and earnings performance. Despite that, revenues rose to €10.8 billion, up 2% year on year, off the back of higher transport volumes and spot rates. Meanwhile, over at Maersk, the company has raised its full-year guidance after reporting a beat on second quarter earnings. The shipping and logistics firm said Q2 results benefited significantly from higher freight rates and improved volumes, and said elevated costs from the Middle East conflict had been recovered through commercial measures. Let's get to Vincent Clerc, who is the CEO of Maersk. Vincent, thank you so much for joining us again today. Just looking at the guidance, which I thought was significant, you've upped the guidance for the full year significantly. The low end of the EBIT range has more than doubled. Do you just want to explain that to us in terms of the outlook?
Yes, I think that obviously this is a really, really strong result in a very disrupted world, and there's a lot of things to unpack. There's been different disruptions over the past quarter, from the war in the Middle East to a new round of tariffs in the US. But what is the key feature for me, or what is going on right now in the shipping markets, is the incredible resilience of demand and the incredible resilience of the economy, which has led volumes to continue completely unabated by any of these disruptions. And as a result of this, we are seeing more and more bottlenecks on the land side, whether it is in Africa, in Europe, or in Latin America, which are causing congestions and pushing freight rates up. And this is what is translating into a new outlook and a new guidance now on the back of very strong shipping market and high price on especially the spot market.
Vincent, that is a fascinating point you've raised to us, because we're not just talking about shipping lanes being redrawn up here. We're talking about inland roads also being impacted by alternative routes. And you flagged this in the release about the amount of inland transportation routes. Just exactly how is this changing? How do the bottlenecks get addressed? How do we think about this rerouting of the global logistics map?
Yeah, I think that for a long time we've looked at the health of trade by looking at the balance between the number of ships that we had and the number of containers that we needed to transport. And I think that what we're seeing now is, as a result of underinvestment in landside infrastructure for the past 15 years and continued growth in traded volumes, we're starting to hit and to stretch the limitations of what the landside can actually cope with. It's true for terminals, it's true for landside infrastructure. And this is being further inflamed by issues such as in Europe, lower water levels on the Rhine, which means less transport possible through waterways, more transports needed to go on road. The Panama Canal having also issues in coping with transits, trucking power availability in many markets being a real challenge to get to support the current trade volumes. And all of this is actually now starting to move into creating a more benign environment for freight rates. And it's going to take time to catch up on 15 years of underinvestment. So as long as the demand is resilient, we feel that actually the outlook for our segment is more benign, and we will see volatility for sure, but we will see more and more of these bottlenecks appearing and being resolved and reappearing again, leading to events such as what we have seen here in the second quarter, and a very different outlook from the year from what we had just 3 months ago.
Vincent, just briefly, I know you warned about potential overcapacity in the shipping industry that could weigh on rates in the future when shipping routes reopen and get back to normal. Is that still a concern, or has that gone?
Well, I think that obviously the order book is very big, and if we lived in a world where still the number of ships divided by the number of containers is what is going to be the main determinant for profitability outlook, then there is reasons for concern. But I think that what we're seeing is really the bottleneck on the supply chain is moving from seafaring capacity to actually inland transportation capacity. And if as long as you have a strong demand, I think that you will see a much more benign environment for the year to come. The other thing is that trade is becoming more imbalanced. A lot of most of the strength that we see in this market is actually on the back of Chinese export and not so much in consumer goods, but more in infrastructure goods, things that are linked to electrification, to energy transition, to data centers, and to different, some of the key infrastructure build-up that need to happen around the world to cope for higher needs for energy, higher needs for electrification, and higher needs to power data centers and AI. And as this plays out, I think we're seeing also what is in the container gradually shift from consumer goods to more infrastructure, which is also more resilient to the economic cycle. And that is, I think, a positive news for Maersk and for the industry in general.
I know you have a busy morning, but just one final question. The situation with the Rhine, very low water levels, a lot of concern around that and the impact on shipping. What's your reading of the situation?
Well, I think that we've seen moments where water levels on European waterways have gone below what is needed for the transport that we use. And we see this becoming more and more often as a result of climate change. I think this is a good illustration of the fact that we're going to need to invest in infrastructure in order to cope for that. It is highly unlikely that the Rhine, if we don't do anything, can continue to be the transport artery that it has been for the past decades if we don't manage water levels differently, or if we don't create alternate capacity on the land side, whether rail or trucks, in order to move those volumes. And we see this resulting in dwell time increases at terminals because it's so hard to find ways to get the containers to their final destination. And this is what is driving some of the dynamics that you're seeing today. So we're going to need investments in terminal capacity. We're going to need investment in inland capacity to cope with the level of trade that we're seeing right now. And certainly the resilience of the economy is a good lead indicator that there is no moment to lose. And it is part of our strategy on the terminal front, but I think it's going to require a lot of efforts from the ecosystems at large to cope with the many bottlenecks that are appearing right now in the supply chain.